All right, let's get into it. Today, we're going to tackle something huge, a battle that's always happening in the background, but most of us don't really see. It's the constant tug of war between fiscal policy and monetary policy. So who's really calling the shots for our economy? Let's find out. So who actually has their hands on the wheel? Is it the politicians we see giving speeches on TV? Or is there someone else kind of pulling the strings behind the curtain? Well, the truth is, it's a lot messier and honestly way more interesting than you'd think. So, on one hand, you've got the government. They make these big, flashy announcements, right? Budgets, stimulus packages, it's all very public. And then, on the other hand, you have the central bank. They're the ones working in the background, quietly tweaking an interest rate, and suddenly the entire market just panics. You see? Two totally different players, but they're both trying to steer the exact same massive ship. Okay, so let's set the stage here. We've got two major powers, each with its own playbook, both trying to manage one single, incredibly complicated economy.
Let's use an analogy, because this makes it super clear. Think of the economy as a car. The government, well, they've got their hands on the gas pedal and the brakes. They're all about speed. But the central bank? They're looking at the engine temperature. They're making sure the whole thing doesn't overheat and explode or stall out completely. Both of them want a smooth ride for sure, but they're fiddling with totally different parts of the machine.
All right, let's start with player number one, the government. And their playbook is called fiscal policy. So what is it, really? In simple terms, fiscal policy is just how the government uses its power to spend money and collect taxes to try and juice the economy or cool it down. And they basically have two main tools in their toolbox. First up is spending. This is the big stuff, right? Building new roads and bridges or sending out stimulus checks directly to people. And their other tool? Taxes. If they cut taxes, you and I and businesses have more cash to spend. If they raise them, well, the opposite happens. The logic behind it all seems pretty simple, right? If the economy is weak, kind of sputtering along, the government floors the gas pedal. They spend more, they tax less, all to get people buying things again. But if things get too hot, if inflation starts to get out of control, they slam on the brakes. They cut spending or raise taxes to pull money out of the system. Okay, but here's the catch, and it is a huge one. This whole process, it's slow, like really, really slow. And why is it so glacial? Well, in a word, politics. Think about it. Any new spending plan or tax cut has to go through endless debates in Parliament or Congress. Politicians argue, elections get in the way. By the time the help actually arrives, the economic problem they were trying to solve might have completely changed. Okay, so that's the government's slow-moving playbook. Now let's switch gears and look at player number two, the central bank. Their game is called monetary policy, and it runs on a whole different clock. So this is all handled by places like the US Federal Reserve or the European Central Bank. And the most important word on this slide is independent. Why is that so important? Well, history has shown us that when politicians control the money printer, they tend to, well, print a lot of money, especially around election time. That leads to chaos and runaway inflation. So creating these independent central banks was like building a firewall, separating short-term political whims from long-term economic health. And their toolkit is completely different from the government's. They're not writing budgets or changing tax codes. Nope. They focus on two things: interest rates, which is basically the cost of borrowing money, and the total supply of money flowing through the economy. And their strategy is just as direct, but it works differently. If the economy is in a slump, they make money cheaper. They cut interest rates, which makes it easier for you to get a mortgage or for a business to get a loan to expand. It encourages everyone to borrow and spend. But if inflation is soaring, they do the exact opposite. They raise interest rates, making borrowing more expensive. That cools spending down and helps get prices under control. And this is their superpower, their key advantage. It is fast, unbelievably fast. There are no political debates, a small committee meets, they vote, and bam, the decision hits the market that very same day. It's a surgical strike compared to the government's slow-moving arm. Okay, so now we have our two players on the field, the government, which is slow but powerful, and the central bank, which is fast and nimble. And this is where we get the great economic tug-of-war. So let's just put it all side by side so you can really see the difference. You've got the government, run by politicians, using spending and taxes. It's slow, and its main goals are usually creating jobs and boosting growth. And then you've got the central bank. They're mostly independent, they're super fast, and their prime directive is keeping inflation and prices stable. See? Different tools, different speeds, even different primary targets. But they're both pulling on the same rope, our economy. And this is exactly where things can go off the rails. Let's go back to our car analogy. Imagine it's an election year, and the government wants everyone to feel good, so they are flooring the gas pedal with tax cuts and spending. But at the same time, the central bank is looking at the dashboard, sees that engine temperature gauge is in the red, that's inflation, and what do? They slam on the brakes by jacking up interest rates. One foot on the gas, one on the brake. What happens to the car?
Well, the result is a mess. You get stimulus packages that just don't work because borrowing is too expensive. You get families struggling with high mortgage payments even when the economy is weak. And the markets, they just get confused and volatile. It creates this huge cloud of uncertainty for everyone.
Okay, so why should you care about all this? It sounds like high-level economic theory, right? Wrong. This battle hits you right where you live. It affects your wallet, your job, pretty much everything. Let's get specific. That mortgage rate you're paying on your house, that's the central bank. Whether businesses in your town are hiring or laying people off, that's a direct result of this push and pull. The price of your groceries, that's the inflation they're fighting over. And whether a recession gets better or worse, yep, that comes down to how well these two forces are working together or against each other.
It's like the quote says, every time you hear about a new government budget or a central bank rate hike, you're literally watching another round of this match play out in real time.
So the big takeaway here is really this. There isn't one person or one group with a magic lever that controls the economy. It's not that simple. It's a constant, messy, and totally fascinating balancing act between the political aims of a government and the stability goals of a central bank. And once you understand this dynamic, you'll start to see the news in a whole new light. So I'll leave you with this question to think about. When you look at the economy right now, who do you think is winning this tug of war? Are they working together, or are they pulling the economy in two different directions?